the moderator. He is the CFO of Star Life Assurance. Then now that's the problem I have, because you see, some of these titles, we don't say Mr. Nana, Mr. Ni, because the titles that they have are Ni. So I rather say Ni Amu, who is the compliance manager at the National Pensions Regulatory Authority. He's stepping in for Mr. David Abbey. Let's welcome him, please. Then there's another person who I cannot call Mr. because he has a title. And his title happens to be Nana Wiafe of Access Pension. And last, but certainly not the least, is a name that I personally associated with way back then, even though I'm sure it is not him. Albert, or Mr. Albert Oko Dagadu. He's the head of technical Old Mutual. The moderator will be Mr. Eric Jebi. So in that case, I will hand over the mic. Incidentally, is your dad the famous, my former boss, Oko Dagadu himself? I don't know if you should make a little comment before he goes and sits down. Those of you who are old enough, like Steve and myself, his father used to do Ga commentary, flawless. Not one single English word will come in. Yet when he's speaking Ga, there's so many English words coming in. Disgraceful. Thank you very much, bro.
All right, thank you. Good afternoon once again. I am privileged to be asking the questions, and I think I like that part. You have to, my panel will have to help me solve the difficult questions I'm struggling with. So I think I will enjoy my seat. I don't know about them. So, boss, to kickstart, we all know DDEP, 2021 to 2022, there were rumors that the government of Ghana is overburdened with debt. There is the possibility that they may not be able to pay, and there were conversations around haircuts here and there. We got up one day and they say, come for a meeting, the banks, insurance companies, pensions, all those things happened. We're not too clear. We're discussing what should be the haircut. It's going to affect principal, interest, back and forth. We went around and eventually there were some conclusions, even though unpalatable for various institutions. For insurance companies, we took our fair share of it. The banks also had their haircuts, pensions and asset management companies as well also take their hit. It brought a whole lot of chaos in the system. A lot of problems we never anticipated. So I think in this time it's critical we probably help how we can discuss this topic and then probably share perspective around them and then the way forward. So with my panel members, we will digest this topic into detail and help us to be able to see how we can strategize around it. So please, Niamu, if I can start with you. Can you share, your industry experiences, how it hit you, how you managed to navigate through the storms, and then how you were able to, whether you even come out of the woods or you are still there struggling. But of course, I know, pensions was terrible. A few people wanted to withdraw their PFs, they couldn't even get them. There was mark-to-market, and people lost investments here and there. For the insurance industry, even between life and general, for example, life had to take a big haircut. General, some even had investment that were supposed to be have maybe 1 year or less to mature. Now it becomes 15 or 14 years. A whole lot of turbulence. So, Nia, if you can start for us.
Okay, thank you, Eric. Thank you for this opportunity. Yeah, so the pension space, I'm sure the conclusion of the matter was that eventually we came out. But initially, there was a whole debate as to how to treat the bonds that the pension schemes had purchased. Unfortunately for us, I would say, following the banking sector cleanup and then the capital market cleanup, a lot more pension funds were committed towards the bonds. So as it stands, we have almost 80% of our assets exposed to GOG. So definitely that creates a big issue for us. And so our participation in the DDP actually delayed until August, when there was a conclusion on how government was to treat ours. Fortunately for us, we had some sweetness to manage the situation. But certainly we had issues with paying benefits. So basically liquidity issues, because a lot of the schemes were relying on the coupons to pay benefits. In 2022, going into 2023, a lot of the schemes were matured based on the law. So the law says that you can withdraw your provident fund. I'm talking about provident fund specifically. You can withdraw your provident fund after 10 years. If you want to do a withdrawal before, there's a tax implication. So a lot of people were just waiting for that 10th anniversary. And it felt just when the DDP was taking effect. And so there's a lot of chaos. We want our money, I had to sit at several AGMs of schemes, employers who had to speak to their staff. And I happened to be in the TEMA office, so you had to do in the industries, manufacturing. You can see the kind of chaos that we had to meet. A lot of discussion, negotiation. So how we dealt with it initially was that schemes that had liquidity, they could do some sort of exchange. And so that you didn't have to go through the haircut way. Because even if you had to go to the market, you're going to lose as much as 40% of your assets. But subsequently, once the DDP or the alternative DDP for the pension funds took effect in August, and we started to receive coupons, because we received coupons that August, because it assumed that we started in February, things have begun to ease. So as it stands now, things have sort of calmed down. The next question is, how do we value the securities? We found a way to, but there are still some questions around it, because there's something they call modification loss or gain. It's an accounting term. And then we're also looking at how do we go beyond that 80% exposure, because I don't think that is the best way to invest. There should be some spread. Thank you.
Thank you, Niamo. Yes, Nana, can you also share your perspective?
All right, thank you very much for the opportunity. So, there was a famous banking sector or financial sector crisis in the US, 2007, 2008. And if you've watched the movie, The Big Short, right? Some people anticipated the mortgage, crisis. And what did they do? They sold those mortgage-backed security short and made, so much money. One famous Trump surrogate, John Paulson, who was being rumored to head, the Treasury Secretary, but pulled out, became a billionaire because of that mortgage trade. So basically, as investors, we should be able to make, a call on the direction of interest rates, on direction of government policy, and then make, our bet. People who were able to anticipate, probably, made money. In our case, at Access, we believe in diversification so much, because diversification, they say, is the only free lunch. So even though Niamu mentioned the average government exposure in the pension side is about 80, consistently, before DDEP, were below, 55%, right? So that was progress. And then we knew, our debt level were rising. We knew it was unsustainable, the way and manner, government was conducting this business, and we knew something had to happen, right? I mean, when we were bold, declaring to the whole world that we are a proud nation and won't go to IMF, we knew it was inevitable, right? So what we did at Axis 2022, I mean, from January, we started selling most of our government bond because we knew something was happening or something would happen. What Niamu mentioned was true. 2023, 10th anniversary of pension fund, a lot of the pension contributors were coming for their money. We didn't know the form the restructuring was going to take, but we didn't want a situation where we think we have maturities in 2023, 2024, and when our contributors, want their money, we tell them there's DDEP. So what we did, we basically, before the minister read his budget, sold all our 2023, 2024 maturities. It was a gamble, it was a bet. So when the DDEP, happened, in terms of paying, outflow, we were pretty much, okay. And like Niamu mentioned, pension fund, we had the benefit of labor, fighting for us. So there was no, haircut, but the major impact was liquidity. If you hadn't anticipated the restructuring and had held on to your government bond, thinking you were going to get maturities in 2023 to meet obligation, you would be, found wanting. So that was basically, how we dealt with the whole, restructuring on the side of Access Pensions. Thank you.
Okay, thank you, Nana. All right, so I'll come back to you. Follow up, but of course, I would like Honorable Man to also give a comment, and then we come and dissect the education strategy. I think you did that and help in a way, but we need to get details into it, so maybe that will follow.
Thank you very much. You know, when you were giving the introduction, anybody sitting there would think you are part of the panelists. Somebody else should be asking the questions because you have the knowledge of what happened. But yeah, I wish I could also say same as Nana said, that they sold off pretty much before the things got bad. But in the insurance industry, well, some anticipated, but we are in a space where, even from a regulator's perspective, the haircuts that are applied on the assets that you hold matters, right, for solvency calculation. Government instruments, who would have thought that government instruments are not risk-free? So insurance companies were exposed, and to varying degrees. The non-life insurers, perhaps not as much as life insurers. So for life insurers, yes, we were exposed, but then maybe where we were fortunate is that, we have long-term insurance contracts. So depending on the terms of the contract, if you come and then you say if you want to, make a run on the insurance company, it may not necessarily favor the policyholder. So I don't think we experienced runs on insurance company, but we had a lot of policyholders and clients coming in to see, checking what's the status of my policy, what is happening to you, trying to give them comfort. The retail clients came in, and then the corporate clients came in. And the corporate clients were the most difficult, I think, because they have a reasonable expectation from previous years where you had credited them with interest that you have earned from these instruments and passed on to them. So, yeah, 2022 financials as well, quite a number of us had to take impairments. So we had depressed assets against liability. So it was tough times, but I don't think any insurance company fell by the way because they couldn't meet. Well, what the regulator did very kindly was also give us a moratorium, right? So they did not necessarily enforce the minimum capital at the time. Otherwise, it could have been serious for quite a number of insurance companies. So they gave a 2-year moratorium to help companies, meander their way through the challenges. So, in a nutshell, life insurers got exposed a lot more than the non-life insurers. He started talking about diversification. He said we'll come into that. But then, yeah, most insurers had to take a step back and revisit their investment strategy and looking forward what they needed to do.
Okay, thank you. My next question, or like I said, I'm going to enjoy answering the questions. Yes, we talk about diversification, but we work within a constrained environment. In Ghana, for example, I mean, the finance theories and principles I learned, they seem not to be making sense. Now, the government too has also, of course, confirmed that because we thought government instruments were risk-free. In fact, if it's risk-free, it means that you have to do no risk management. So when we're investing there, we just put the money there and go and sleep. We woke up and realized that no, those theories we learn in school are no more relevant, or they are not applicable in our environment. If you look at our economic structure, our investment space, options and opportunities that we have, yes, we need to diversify. I think, like Nana said, I mean, it's the best, irrespective of whatever. But then how do you diversify your investment portfolio amidst this constraint where, for example, as of now, the banks are even offering you rates that are lower than the government rates. T-bills are hovering around 26, 29. Banks will be giving you 15%. You go to the equity market and you are very limited and constrained. Private equity is not really active. The actually constraints are made the fact that you need to diversify. So how do we navigate through this difficulty to achieve the diversification, objective we want to? Yes.
Sure. Thank you very much. So yes, the premise, is pretty right. We don't have a very deep capital market that encourages diversification. However, within the constraints of our underdeveloped capital market and the constraints our regulator has set for us, there's so much opportunity to diversify. Right? So again, 2022 for our schemes was the best year on record. And really, when we are investing and diversifying, returns are not the primary objective, right? It is part of the consideration, but then if you consider return, really, then we should all pack money and then put into a mono asset class, right? So return is not the driving consideration. Going back to what I was saying, 2022 was our best year. Why? Because within the constraint of what the MPRA has set for us, we could do up to 70% or 75% government bond. Equities on the stock market up to 25%. Ask how many pension funds have even up to 3% exposure to equities. When we sold our bonds, what did we do? Right? There's an instrument on the Ghana Stock Exchange called the ABSA New Gold ETF. It's a gold ETF, gold. It tracks the prices of gold. When we sold, we put up to 5%. That's what the constraint MPRA has set for us into that instrument. 2022, what did our currency do? Depreciated by a whole lot, right? And what did gold price do? Gold price, rallied so much. So that asset, gave us over 120% return in that year. So within the constraints, right, of our investment guideline, there's so much we can do. Mutual funds, we could do up to 30%. We have varied, mutual funds. And most of these mutual funds don't even have exposures to government securities. They are mutual funds that invest in global markets. The question is, how many of us are availing ourselves, to it? So yes, it's a difficult, capital market, but there are opportunities within, the asset, classes available in Ghana. There's MTN, such a large behemoth, almost a monopoly, struggled, to raise 2 billion during their IPO, right? They had to, go on localization spree from 2018 when they listed. They just completed localization just a month ago. What was pension funds, doing? So yes, it's a difficult capital market, but the opportunities, you talked about private equity. There are quite a number of private equity, guys, around Oasis. And like I mentioned, really, return is not the driving, force, but ultimately, you'd realize, I mean, when you do your work well, when you do your DD, returns, I mean, follow. There's Injaro, there's Oasis. There are quite a number of private capital instruments available that institutional investors like the insurance firms over here and the pension fund can avail themselves, I mean, to. But I was telling Yamu that no matter what, I mean, no matter, I mean, how developed our capital market is, if I have absolute call to make decision or set allocation, there's no way I would do less than 40%, 45% in government bond, despite the DDEP, because they also play a role, right, in our portfolio. Coupon for liquidity. It's easier, I mean, to sell when you need, I mean, to pay huge outflow. So yes, I mean, we can diversify within the constraint of investment guidelines set by regulators and also the level of development within our capital market. Thank you.
Okay. Maybe just to add to what Nana is talking about, I mean, he's talked about the opportunities to diversify, but I think what we also identified as a regulator in the pension space was it seems that there was a trend and trustees seem to be following the trend. Those who are responsible for managing the funds. And that was towards what seemed safe or what was comfortable without looking at the bigger picture. Like Nana mentioned, there was a reason or there's a reason why government securities are still necessary in spite of the DDEP. So maybe what we did or what we've been doing to help with that change of mindset when it comes to diversification is to do some training. So we have a National Pensions College and we enforce for trustees to do a CPD. So there's a basic training they do that every trustee needs to do when they come in. To address this particular concern, we did 2 CPDs, one on alternative investments, another on risk management. And anyone who has been through the program on the alternative investments will tell you that the first module for the program discusses the issues that they are facing with the traditional securities and dispels the notions around alternative investments and introduces the idea of really doing what we call the risk return measurement to understand what that is. And that primarily should inform how you invest. It's not just about the return. We have various objectives. Like, for example, we have come to a point where we realize that we cannot treat tier 2 portfolios in the same way as we treat tier 3. Tier 3 is more volatile. People can come for their assets at any time. So you have to structure it in such a way that it addresses that particular objective. So the objective for which you are running your pension funds should also be made very clear. You should understand it and it should inform your approach. So the CPDs were basically to help to get the trustees into that mindset. Thank you.
Okay, so as a follow-up to that, I mean, if you look at our market, for example, if you look at our history, men's gold, so generally, Ghanaians typically follow high returns, or it's not true. We do. So in an attempt to achieve diversification, so the question comes, the competition will tell you, okay, you diversified and eventually give me 5% return. When if I've taken the money here, I would have gotten this. Then more or less, you are being priced out of the market in a way. How do you balance? Because one, that will even require general education across, and I think it's not still gone down. How are you able to balance this, I mean, diversification and the return question? But you would address the insurance perspective because, yeah, so I come to you and then you handle the other bit with a regulatory constraint on asset discount. So Nana and...
Sure. So again, I mean, we set an investment, what do we call it? Benchmark return for our schemes, right? And what we found out is that, I mean, most firms or asset managers, their benchmark is based on a single asset. So you read the investment policy statement of most scheme and then, okay, benchmark is a government of Ghana bond plus 2%, right? If you have such a benchmark, it imposes constraint on you. You are forced, I mean, to diversify. But then our benchmark is asset weighted. So assuming we just have 2 assets, classes, right, we are allowed to invest in, say, equities and bond. And then our equity IPS is, say, 50%, right? And our bond IPS is 50%. Our benchmark is 50% times Ghana Stock Exchange Composite Index return plus 50% of a government, bond, say, benchmark. So at the end of the day, once your benchmark is asset weighted, if I invest in equities, and equities generate, say, negative return, right? My return should somehow, reflect, the benchmark. Of course, I'm expected to outperform what the index, the Ghana Stock Exchange, would generate. But once you have benchmark, weighted, right, it reduces, the burden to beat probably an unrealistic, benchmark. And for a very long time, government returns, were high. So we have, our investment policy, we could do up to 55%, bonds, about 20%, equities, about 15% alternatives, right, about 10% corporate bond. So we have, benchmark for all this asset class. So our overall benchmark is the allocation multiplied, by the benchmark returns, summed across all the asset class. So it reduces that, pressure, to always, churn return above some abnormal, the benchmark. But having said that, return may not be a consideration, but I believe if you diversify, well, right, over the long term, your performance would be exceptional. Like I mentioned, 2022, in the midst of DDEP, our schemes, did an average of about 36%. Right, we had clients who kept calling because of the men's good experience. So Ghanaians are learning. Tell your return is 30 something. Government of Ghana is around 18. What is happening? What is happening? Then we have to explain. Oh, we took a bet. We bought, some dollar-denominated assets, and the currency depreciated. That's why you are seeing. So I think, there's been some change in perspective. But then if you diversify over the long term, you would definitely, achieve, good returns.
Just a brief comment. Just to top up, so pension investments is much like holding a portfolio of equity investments. As an individual investor, if you were doing equity investments, the advice given is that you need to hold your investments and monitor the market over a long time. I mentioned the investment objective, and our objective for pensions is long term. And so if you are looking at return in the immediate, you might shoot yourself in the foot. You heard the strategy that they pulled and got them where they need to get to. And I think if you look at risk and you are focusing only on how much you are getting and not looking at the other parameters, it creates a problem. I think we probably can learn from what NIC is trying to implement when it comes to the RBC. Risk-based capital. It's not just one parameter that informs it. You look across and it informs. It might look like, why is that someone is going for 40%? Why don't I just go for the 40%? But the question you must ask yourself is, at what cost? Interestingly, our law has as the very first provision, when it talks, the part of the law that talks about investments of pension funds, the very first provision says that trustees must invest with intention for safe and fair returns. There's no aggression when it comes to pension investments. And so that is the mindset with which we would normally encourage trustees to invest. Thank you.
Thank you. I think thank you very much. From the pensions perspective, it's much more easier. But when it comes to the insurance, in trying to even achieve diversification, there are asset discounts as well. So when you go to alternative investment, the regulator will put some discounts on. And then, it's the government instrument, the government will have no discount. So that's the challenge. Yeah, so Oko, this is your problem. Solve it for us.
Yeah? You said it right. So maybe let me give it from the perspective of my company, what we did. The reality is, if you chase the return, you may get burnt. So we first of all had to go back to our investment mandate and do a review of the investment mandate. we can't run away from government securities, but how much do you want to place there? And then, just like Nana said, there are instruments on the stock exchange which we can dabble in, but you also have to be conscious of how much your investment mandate is defining for you. So we did that as well. But one big thing we did was risk accept the gap in matching, between our assets and liabilities. So we had to do our stress test. How much are we exposed to, and decide, well, if we are not matched to this percentage variance, are we able to absorb it should anything happen? So I think first of all, you just need to be able to decide what your risk appetite is. And if, should it happen, how much of it will you be able to absorb? Obviously within the regulatory confines. It's not been easy. We've also tried to make sure that even in government securities, we are keeping it short, because you don't know, you just can't afford to go too long. Otherwise, you don't know when you'll be able to come out of it. But yeah, we found some non-traditional investments as well, but couldn't take the bite immediately. So we are still observing and then assessing to see how much of it you can buy. But yeah, just as you say, you are really restricted within the markets, what's available to take up. But you just have to find a way to, bridge the borders and then also make sure that you are returning something to your customers. But I think in all of this, being able to communicate to your clients is most important. Because if your clients don't understand, and then, they've seen bonuses that have been credited that are healthy, and then now you're almost declaring nothing, then that's when the problem is. So we've done a lot of engagement with our policyholders. I can't say they're all happy, but at least, we've been able to keep them on side still for the moment. So yeah, that's where really it has worked for us.
Thank you. So within the constraint, do you think it's time for us to probably get back and revise our investment policies and strategies? Probably involve the regulator as well, because for insurance industry, like I said, if you're trying to diversify, they are constrained and you are struggling. If you get into maybe alternate, you could have like 30% discount. And it means that you need to have capital to actually support that discount. If you don't diversify, the easiest option is to also get back into government. And now, of course, government has proven that they cannot be fully reliable. So what do you think? And what would you suggest? And how do we approach it in the light of between the board, management, and then the regulator as well, so that we can probably have a revised approach to this? Because for insurance, for example, if you move out, you are investing in a foreign assets, there are discounts, there are constraints, or you may not be recognized at all for solvency purpose. And these are really difficult regulatory constraints that you have.
So on your last point, that's, what we have also started engaging the regulator on. Because even as small as it is, it could be a safe instrument like the US Treasury security. Because, well, the capital flight, we recognize that, right? But we do need to provide value to our policyholders. So, in the last few months, we've sent a letter requesting for, allowance to be able to have some placements. There were Eurobonds, local Eurobonds, which have also gone into DDEP. So imagine if you were playing in that space as well. So if they would give us some small space, that maybe we should attack it as an industry together. The regulator in our engagements with them, they have been very accommodating to listen. And I don't think they will be against a small margin, right? So that we are keeping our policyholders. Because insurance is difficult. If we lose them, getting them back in again will be very difficult. So that would be my first approach. In terms of the directors, directors want to see that the shareholder capital is protected. At the same time, they want to see that it's growing. So the question is always asked, where else are you looking to place investments? But as I said before, we've given scenarios, we've done the stress test, and then we've demonstrated to them where the impacts could be and what it could mean. What we've asked for is a bit of time, because this wave too shall blow at some point, So in the meanwhile, the measures I mentioned are what we are doing to make sure that at least we are giving them value, and then protecting the shareholder value as well.
And any comment?
Yeah, so, on the foreign, side, I agree with him. Just some little allocation outside wouldn't hurt. Right? We actually, started that because we found an opportunity within our pension law and started some investments, outside, but then the regulator stopped us in our track. So it's over to him. But then other than that, I think, the recent MPRA pension guideline came out, after extensive consultation between the regulators and the industry. And I feel it addresses most of the issues around diversification. It's just left with fund managers and the trustees to actually go out there, seek such opportunities and then diversify pension funds. Thankfully, we don't have all those risk-weighted, discounts, right? It's about absolute, return. And we also, have some bit of patient, capital, especially on the tier 2 side. So yes, the opportunities, it needs a bit of courage, to actually dare to ensure we have our members, assets very well diversified. So pretty much, okay on the regulated asset prescription side. Yeah, thank you.
Regulator.
Don't worry, he's not under duress. He's free to speak.
It's written to you, okay.
Yeah, the issue with the external investment. So we actually have a policy to review our investment guidelines every 2 years. It's actually due for that. Indeed, we have created room for external investments, which is up to 5%. But there are some other conditionalities that create some hindrances. And the industry has approached us. And so there's actually a discussion that has started. And we're just looking at how to iron it out to make it easier for pension funds to do external investment. Our law says we need to get the permission of the president. And so we need to see how we can create ease around that. Of course, we are concerned about the risks that are involved. So those considerations would come into play when we are finalizing whatever policy that we need to do. But we see the opportunity there. Once there are proceeds from those investments, that's also foreign currency coming back to the country. And it's almost as if the country is holding foreign reserves because of the kind of investments that are being done at the pension fund. So I see it as an opportunity. And our biggest problem in this country is our currency losing value. And so that is also a way of adding value to the pension funds that we are all looking to enjoy someday. Yeah. Thank you.
Thank you. So, that's also a fantastic perspective. But the other perspective is that, of course, countries also use pensions as a long-term development fund kind of. So, yes, it's good for us to achieve this, but it looks like we try to solve the problem and then we create a problem and objectives are being. How do we, manage this? Because one, if you're able to manage your long-term funds, especially pension funds, if we manage it properly, we should be able to use that one to embark on serious developmental projects. Or the question is, we are not really good at managing our own resources. How do we address that?
Okay, so our investment guidelines already gives that room. Under the alternative investment asset class, there are some securities. We say you can do direct finance into real estate. You can also do project financing. And I think in both cases, we are asking that you have government partnership It doesn't need to be GOG itself. It can be a government institution. And we also want a development bank, basically, a foreign financial partner who understands the space that you're entering. Because obviously a pension fund is supposed to be managing pension funds and not real estate contractors. There's also issue of obviously of capacity of the trustees. So it's creating some hesitance entering that space, but Axis, there are some other trustees that are venturing into actually influencing investments locally. If you open our investment guidelines, the first objective that has been set out for investment of pension funds is actually to influence investments in Ghana. So that is actually an expectation that we have. So that is probably the reason why we have just limited external investments to 5%. There's a reason for that, as I mentioned. But largely, 95% is still available to be used for this purpose.
Okay, thank you.
I mean, I perfectly agree with Nee.
Sorry?
I agree with Nee. I mean, 5% would hurt.
What they had?
Yeah,
Okay,
it
yeah,
would
I
hurt.
think that's fine. Oko, this one, I think more of life insurance, so you can address it for us. Are there any strategies that we can probably adopt to help hedge our liability as well? Because if you look at the life insurance space, especially those of us who sell endowment, we usually will promise actually this amount within 5 years and things. Will you recommend any strategies to help manage or hedge against those liabilities or promises we've made? For the pensions, I think generally they are not required to make promises or commit people, so returns based on what you make.
I think as much as possible, we should minimize guarantees, the promises in the policy word, in the terms and conditions. If government securities could drop us in this kind of pool, we can't. They said usually this is a 1 in 200 years event, but we can't trust that this will never happen again. So where we can redesign our products and minimize guarantees. I know for some companies you have, promises of maybe T-bills plus X, right? As much as possible, if we can minimize those introductions in our products, I think that would help us greatly. So we minimize guarantees, we review our terms and conditions, not to make put the policyholders at a disadvantage, but actually to make it safe for everyone to buy the products and be confident that the payouts would come when they are due. And then also, we are life insurers, so we're always looking at long-term products. We just need to engage government and then regulator to do better, especially government. And then, when bonds are being issued, they should consider the insurance pool. We have insurance companies with large long-term liabilities, right? So if they had bonds that were of such duration, maybe we wouldn't have been worried that you were rebucketing it for and then pay out in 2037 because, the liabilities were matched to that duration anyway. So you find that we have gone and bought securities and then we have to keep rebalancing, and then you are rebalancing now at a disadvantage. So it's engagement with regulator and obviously government on some of the instruments that they make available. And if our corporate organizations also will become a bit better. So when you are buying a corporate bond, there's a lot more confidence. So really, it's the macros being better. If the macros are better, you get a bit more confidence. But what we can do, and that's within our control, is to reduce guarantees in our products and then watch the policy terms and conditions.
Thank you, Oko. Do you think it's time probably we have an innovative approach to addressing? Because for example, now if you want liquidity, either you go and then it's marked to the market and then, so especially where asset liability mismatch, or especially even for pensions, similar, like when people are withdrawing their PF, here and there. And then you are forced to either go and discount your bonds or whatever. And then either you pass on directly the loss to the clients or, you absorb it. For insurance, of course, we have to probably absorb it. For pensions, yes, the clients will absorb it and so on and so forth. Do you think we need to think about an innovative approach where we will have like an intermediary that will help balance and manage the situation for us until things stabilize? So at least in terms of the losses, it's minimized a bit because now if you get to the market, probably you have to discount at 26, 29% to get liquidity. And that could be quite substantial because within our various industries, we have to be thinking about how to meet solvency requirements here and there, especially for insurance companies and health, life, general, and co. And I think it's burdensome because when you look at it, and especially if you haven't asset liability mismatch, you will definitely have to think about how you can unwind the situation and be able to survive in a way, at least in the short term. And then maybe in the medium term, when the macros get better, require very active trading, active market for the trading of these securities where the discounts are fairly reasonable and manageable for various stakeholders.
So I'll leave the innovation around the assets to the asset managers. But in terms of products, actually, for a life insurance, for instance, perhaps you could also think about a bonus smoothing account where we are crediting bonuses that we have earned. Let's not pass all on in a particular year. So that's part of the redesign of the products I was talking about. So if our policyholders understand that we are keeping some for a rainy day, I think they will be amenable to that. So in periods where the market is depressed, there is a bonus smoothing account which comes to plug in some of the losses that would have happened. So you manage to keep the reasonable expectation of your policyholders, even if not at par, at least close to par. So that's also one of the innovative ways we could introduce to keep our policyholders on side. When it comes to the assets and then an intermediary in between, maybe I'll leave it to the experts.
Thank you. So basically, I think institutions should be responsible for their liquidity, right? You don't want any regulatory or government intervention, right? You need to be able to understand what your liabilities are, right? And plan for it. I heard a famous investment manager in the US saying, if you are a fixed income manager, right? And really our market is primarily fixed income. Your role, just listen to what central bank and government, says, most importantly, what they do. And then build, your strategy, around, that. You would be fine. I think risk management, liquidity management planning should be left to the institution. Nobody should come and intervene. That's also taxpayers' money, right? Because if we are going to, build an intermediary to provide, help, that is my small, tax going to bail out firms who do not plan their liquidity well. So I think it should be left to the institutions. And if you feel, you pay a price. Yeah, thank you.
I get that bit, which I agree with you to a greater extent. What actually I was trying to, so yes, your liquidity manager should be responsible for it, all right. But what we are now, we didn't necessarily create it. The government that created it. And then the problem might not be that you're not solvent, or you are not necessarily, you wouldn't have been liquid. I don't know, be a destruction. So for example, if I had a bond that had like 6 months to mature, 1 year to mature, I had planned that 1 year I'll have this money. The government comes in and now he's prolonged this to like 14 years. Really, it wasn't my problem. Not that in the short term years, it's created so much problem, but the asset is still there to a greater extent.
Obviously, DDP was a black swan event.
Yeah.
We needed all the support, but then going forward, under normal circumstances or normal condition, we should be able to manage our liquidity.
Yeah, I agree. Yeah, Mo, you want to comment? Yeah, okay. Answer all. I think probably if there are questions from the audience as well, I think we've exhausted.
Are there? There's one already. Any other ones? Two. Okay. So let me bear with me. But before I do that, please, a round of applause for Eric and his team. I went back. Eric, Niamu, Nana Riafe, and of course, Albert Okodagadu. And then big ups. That's what the current generation say. Big ups to all the actuarial science students in-house here. Where are you? Let's give them a round of applause. There are quite a few of them from all the various tertiary institutions. Right, there's a question from here.
All right, thank you very much, Eric. In dealing with the expected credit loss, some companies were considering three options. Some were considering whether to absorb the whole provision against their P&L. Others were also considering whether they should hit it against the policyholder's account or they should share it. I want to know from the company sitting here, practically, what you did.
Very straight question. No ambiguity whatsoever. And the one person here? Good, please.
Okay.
You can shoot away.
Okay, so it depends on the nature of the contract that you have with your clients. So, for example, if you sold an endowment where you promised a specific amount on a specific date, in that case, I think generally it's not fair to, unless you cannot avoid it and you are going to die, then you negotiate. But then where you have done that for endowment, so practically what we did was that we didn't let policyholders suffer. So we took the hit and we had to take care of all the impairment as a company. For universal policies that allowed for maybe the share of returns or bonuses or whatever, you had a flexibility. But even that one, yes, you look at having a fine balance between your organization and then the client, so that you don't satisfy the client at the expense of the organization. I mean, you need to have a fine balance. And I think that's what most of us did. So from my perspective, yes, that's what we did. I don't know, Oko, what you did.
Exactly the same. So we absorbed a lot of it, and then for the savings or universal type products, depending on the nature of the contract. And yeah.
Thank you, Eric. So my question goes to Albert. So you spoke about having a bonus account on which from time to time you'll be crediting to the various clients. So imagine you've built up a certain fund to a certain level. What happens to current clients who will be withdrawing? Would that not be a cheat on them?
So at the time that you are exiting, okay, maybe let me backtrack. Once the bonus smoothing account is set up, every member of the fund has an amount that is tied to him, if you get what I mean. Because you know what the structure is, you know how much you are crediting to everybody based on whatever their funds was at the beginning of the year. So when he's exiting at maturity, obviously, because you don't want early withdrawals that would drain it, then you would add whatever he's accrued together with what was sitting in the bonus smoothing account to his funds. So if it's early withdrawal, then you don't get from that bonus smoothing account. But managing it you have to be careful how you manage it. Administratively, it could be a nightmare. So you have to have the right systems in place so that you manage it properly.
Anybody else? Nobody? Okay, continuation.
So this one goes to Nana Riafe. So he spoke about, the prediction that somebody did regarding the US financial crisis. And the fact that they saw what was going to happen in Ghana, and so they started selling off. Now, historically, Ghana has been to the IMF, I think about 17 to 18 times. Meaning that from 1957, every 4 to 5 years, you go to the IMF. Only that we have not defaulted not paying people their funds. So looking at the trajectory where now the restructured funds or debt is going to take 12 to now even 15 years, what do you think will happen?
He says you are a soothsayer. Prophesy. What? It's not.
So, I mean, I can't tell you what will happen. I mean, then, but I mean, if you need to be an optimist, right, to be an investor. So we hope. I mean, government is able to meet the obligations, right? And of course, I mean, the IMF program was just to bring us, I mean, on track. So once we follow the advice, right, and then cut, I mean, our quotes according to our size, but we should be better. We should be better. I mean, there's risk, I mean, everywhere, but I mean, there's risk in everything, I mean, we do. You just have to manage it. But then I don't see any default, I mean, ahead, right? I don't see any default ahead. That doesn't mean, I mean, put all your eggs in one basket, right? Just diversify, right? Diversify. And then,
Albert, I thought I saw you making a gesture too.
No,
What about Neil?
he's only saying it's a 1 in 200 year event. So
Neil, what about you?
I think he sort of answered his.
That's the point I was trying to get.
Yeah, because if it's a cycle, then we'll definitely get out of it. I mean, maybe you now have to anticipate when it goes bad again, and then you take Nane's approach of pulling back. So I think it's inevitable. Every economy has a cycle. And I think the important thing is to know it. And that is what puts you in an advantage.
What happens when you have, I mean, because this threat is real. I mentioned it playfully, but what happens if you have tariffs being imposed, left, right, center, and a company which probably was depending on certain goods coming in and the tariffs was like 2%, now that defines that what? It's 50%.
So I think it comes back, I mean, for those in the regulatory space, perhaps if you're talking about tariffs, we're probably looking at the regulatory constraints that we put on the institutions. I'm hearing what is happening in the insurance, even when they want to pursue opportunities. So I think you need a friendly regulator to be able to manage that situation. I think it comes back to the question he was asking, whether there should be some liquidity intermediary to, so the regulator needs to figure out ways in which we can work together. And I think in the insurance space and the pension space, they have that. And so normally you would not see an increase in the tariffs. You rather trying to see that there's some regulatory forbearances. I think it was mentioned that during the DDEP, the capital requirements, we were not too stringent on it. We rather give time for the insurance companies. It's the same in the pension space.
Right. If there are no more questions, big thanks to you, Eric, JB, Ni Amu, Nana Wiafe, and Albert Oko Dagadu. Mark. Mark, where art thou? Okay, so I don't know if I should call Mark the administrator, but he's the guy who really does a lot of work here, and he's going to do a little presentation. It's not going to be too long, 20 minutes maximum, and then we'll round up and go, and it'll be on what?
Gain intervention.
Okay, go ahead.
Right. Good afternoon. Hello. Briefly, we will go through the UNDP gain interventions that we have been undertaking over the last year. I don't want to spend a lot of time because we are all exhausted. In fact, I am super exhausted. I need to run out of here and get some sleep. Right. To the main task of the day, can we go to? Right. So, somewhere last year, we began UNDP Milliman Global Actuarial Initiative Program in Ghana. It's also going on across other jurisdictions on the African continent and beyond Africa. They are key partners to this project, though it's been driven by Milliman, a multinational consulting outfit that has that is stationed in a number of companies. There are a couple of partners in Ghana's project. These are mainly professional body, and that's where ESG comes in because it is an actuarial related stuff. Obviously, you can't go around us. We have to lead the way. We also have regulators like the GIA and the NIC that is supporting this initiative. And for us, it's super helpful because if you have a regulator partnering you on some of these projects, there's a likelihood that you are going to make it happen. The success rate will be a bit high. Then there is the development organization, which is the UNDP, that is actually facilitating some of the projects. So, can we move to the next? Right. So, in Ghana's project, we have 7 main interventions. I'll quickly run through, then we'll delve a bit deeper into some of them, not all of them anyway. So we have intervention 1, which is our graduate actuarial training program. You can see NSS in brackets, and I'll explain that shortly. And then the NACDEF. We'll go into detail. Then there's also the mortality table construction. Earlier on, you may have heard the commissioner and the ASG president mention of the progress that has been made in that direction. We also added morbidity tables, which is very essential for the health insurance market. Then there is also a senior management seminar on actuarial functions. We are also trying to facilitate an actuarial bill in Parliament. Then there's also a mentorship program and an aggregated public data repository. There's also microinsurance pricing toolkits. So we'll look at a few of them, those that we have made significant progress, and I'll touch on those that the progress is also a bit slow. The first one is the mortality table. So let me be quick to say that we have not touched on the morbidity tables at all, nor the mortality tables for like a national mortality table. But this is an assured life mortality table. So key partners that have been involved, again, has been ASG, NIC, GIA, and their functions are also stated there. I forgot to mention that ASG is also leading the analysis and the development of the tables. Okay. There are certain challenges that we encountered. I'll touch on data submission. I'm told it was difficult getting most of the companies to submit data. But thanks to the NIC and GIE, we've gone past that hurdle now. We're able to get 9 companies to submit data for the assured life mortality tables to be developed. There were also missing fields in the data, in the template that was returned from the companies. I think in the future, most of the companies may have to look at their systems to be able to bring out the right data, because it won't end here. There has to be what we call CMI, continuous mortality investigations. So beyond this, periodically every 5 years, or depending on what is agreed, there has to be an update of the mortality table. So maybe companies may have to consider the nitty-gritties in future. The current status, data cleaning is done. I'm told initial analysis is also done. The construction of the table is actually ongoing, and then there would also be review. So the green ones are checked, we hope that the next two will be done soon, so that, like the president said, we can have an industry launch of assured life mortality table. Next. So that is just one of the intervention, intervention two. This is the first one. So those of you who are aware of our graduate actuarial training program, since 2018, what we do is that we place actuarial graduates in the companies, and what we do is that we train them before placing them. So we go through a 6 weeks rigorous Excel VBA training before we post them. So as part of that, we developed what we call the non-life actuarial capacity development program last year. What it sought to do was that we realized that in the current act, the section 77 of the Insurance Act, insurance companies are required by law to have an actuarial outfit. But we realized that the non-life space had zero actuarial outfit. And so we leveraged on that to say, why not build capacity in that space so that we can actually have actuarial outfits operating within the non-life space. So the first thing we did was to, and I'll talk about that again, was to meet with the HRs to get their buy-in. So we met with the HRs, got their buy-in, tried to let them understand that, in fact, when you continue in the section 77, it says that the actuarial control function cannot be outsourced. So what that means is that necessarily every company needed to have it in their corporate setting. But then there was none. So we needed to start from scratch and find a way we could. And that's where the non-life actuarial capacity development program comes in. Participation. So we have 17 companies out of 23 non-life companies that has joined. And each company brought in staff. Some of them had to nominate. Some of them too, we had to give them the graduate actuarial trainees. So the NSS guys that we trained, we gave them. And they have started the actuarial outfit with them. We had two regulators that are also participating. NIC and NHIA are also participating. But there's a new development which we will come to very soon. Training. So we do quarterly trainings for the nominees or the actuarial staff that are within the companies that are actually participating. What we have also built in is that we expect that as the trainees go through the program, they make efforts to progress through the actuarial examination. And then there is a third module that we are currently developing. That is what we call the Actuarial Skills Certification Program. So the discussion now is around the fact that can we say that after the 3 years program, person X can actually do the full scope of work within a non-life actuarial settings? And that is one of the objectives. How do we achieve that? How do we know that person X can actually do it? So we are currently in discussion with Billyman to develop what we call the Actuarial Skills Certification Program, so that anybody that goes through is tested that he can actually carry out, say, reserving back to back. So if he walks into a company, he can confidently tell the company that I can do your reserving for you. So that is the level we are now. We are developing the modules so that the different trainings that we are undergoing, we can actually test your skill and not come to a training, because for us, participating in a training is different from being able to do it. You can come to a training, whether skill-based or seminar type of training, but at the end of the day, you don't know how to do what we are talking about. We want to distinguish between that. For us, so we are moving to that level where we want our trainees to be able to test themselves in our model and say that I am actually fit to do this for a company. Yes? Right, so still on the non-life actuarial capacity development program, I mentioned a few of the things earlier on. So the first thing we did was talk to the HR guys to get their buy-in, because we realized that they are very key to advancing the actuarial skill set, and then the actuarial role within a particular non-life company. So we spoke to them first, and then we asked them to recruit, and that's where our graduate actuarial training program comes in. Most of them, we gave them graduate trainees. Some of them also had to nominate existing staff who are analytically inclined to join the program. Then we had a kickoff meeting somewhere in January this year. We had a kickoff meeting with all the stakeholders where we also involved management. So one of the things we do is that we go to each company with our actuarial advisors. So I'll talk about the actuarial advisors in the next bulletin. So what happens is that we go to them and then we engage the company and say, we are going to assign you an actuarial advisor. The role of the actuarial advisor is not to the company, it's to the nominee. His role is that after we have gone through the training, he is going to engage the nominee and make sure whatever training we did in the space of the next quarter, they are able to actually do it. So in February, we did reserving. And after the reserving training, what every actuarial advisor will do with their paired actuarial representatives or staff is that they will have 3 hours of engagement every week with them, giving them assignments and projects on the reserving to do to see if they're actually making progress. So it's a very comprehensive program where the actuarial advisors are engaging you consistently, almost every week. And the progress has been phenomenal. So we also assigned actuarial advisors, like I say, depending on the numbers that each company is bringing. Some companies brought 2, 3 to participate in the program. And that's why you see the numbers being 37 and not directly matching the number of companies. Like I said, they guide them through. So we've done 3 trainings so far, 2. Next week we are doing the 3rd one. We've done reserving, we've done data analytics with Python, and we are now on to reinsurance optimization next week. There are other training programs that are scheduled for next year that will undergo. And mind you, all these training programs are not the seminar kind of training where we come to talk. They are skill-based trainings where they come with their laptops, they are run through, and after that, the actual advisor will take it up from there, engage them with projects and assignments until they are sure the gentleman or the lady can actually do what is expected of them. The next step is the actual skill certification program we talked about. We are still developing the module with Milliman. Then we want to replicate the same thing for the health insurance space. We realized that we haven't touched on the health insurance space for a long time. We've left them unattended to. They are going to replicate the same thing from next year with them. So the other interventions, we haven't made too much progress, but we have made effort. There is a management training. Like I said, the first people we engaged was HR. We let them understand that, look, you need this skill set in your company because their roles is not just in that one corner, but then it's multifaceted. We are talking to claims, we are talking to reinsurance guys, we are talking to underwriting, we are talking to finance, especially in the era of IFRS 17. And so we had to engage them. Quite recently, I think 2 months ago, we had a management training with CEOs, also trying to let them understand the same thing and also get their buy-in for a lot of the things that we are doing. We didn't touch on the CFOs because we know with the IFRS 17, they are engaged, the actuarial staff. But then we are hoping that next year, we can also come to the CFOs and try and strike that synergy so that we can move forward. So that's for the management training. That's one of the interventions. There's also the mentorship program. So the first cohort of mentees were 6 that were assigned to mentors to help them through their actuarial career, and it involved a number of things. including exam guidance and other things. Then the actual bill, we have the first draft that is available that we are reviewing because there are still a number of things we want in there. So that's where we are in terms of that. So those are the three that we've made slow progress. There is one we haven't touched at all. We are hoping that next year, you can move to the next slide. We are hoping that next year we can touch on that, and that is the aggregate data repository. We hope to be able to mobilize data from the non-life companies, especially within the claims space, and do a number of things with it. We are looking at developing a fraud model that is able to give an indication of, especially for the motor that is mandatory, to be able to give an indication of who is becoming a bit fraudulent or not, especially when you're having a doctor signing in Accra, the same doctor signing in Kumasi and some other place. It makes it a bit. But then we would want to develop the scope well so that when we move, we are engaging them and not breaking halfway. The other thing is to do the mobility tables. I've already talked about the non-life actuarial capacity development program for the health sector, so I won't go to that. So mobility table is something we also want to do, especially for the health insurance industry. And that's how far we've come with the Milliman Gain program. As a professional body, we wanted to give you an update. We know most of you are not privy to some of these things. Hopefully, very soon, we'll try to put everything online so that you can have more information and not have it when you come for meetings like this. Thank you. Yep. Any questions?
Surely. Oh, you're bad. Okay, if no questions, that's fine by me. Mark, thank you very much. God bless you. All right, so we've got to that stage where we're going to end, but we can't end because we need to have closing remarks from the incoming president. That's what I was told. Please blame Mark for stabbing you in the back. You don't blame me. So, can I humbly request for Mr. Kofi in team to please come and give his closing remarks.
Thank you. Thank you, beautiful people. Thank you for being here the whole day, spending your time with us. And we do thank, on behalf of the ASG, we do thank the speakers for what they have impacted on us. We do thank you for making time to join us for this program. Day 2 is tomorrow, and for day 2, we'll be having 3 different sessions, but they will be broken up into 3 things. So if we do know that you enjoyed today, so we do encourage that you show up tomorrow for a better day. Thank you very much.
Right, so the president says all that. And tomorrow, day 2, we're going to have quite an interesting session. It looks quite, I've seen some names here. Michael Brown. Who is Michael Brown? Oh, there you are. Then can I presume that is Angie Mitchell? Absolutely. That sounds very, sorry to use the language, Englishy. From England? South Africa. Okay. I'm sure your antecedents must have come from the UK somehow. You know, yeah. Anyway, so they'll be there. All of us will be here. Thank you very much for being here with us, staying with us this long. And as is the tradition, I'm going to invite the outgoing president to give us the closing prayer. We didn't start with an opening prayer. in this country, we start with prayers. So, New Table, please give us the closing prayer.
Shall we be upstanding, please? Father, we thank you for bringing us this far. We started with your presence, and we have ended with your presence. We thank you for everyone that presented today and participated. We're going home. Pray for guidance, transportation mercies, that we will go and come here tomorrow to continue on this function. We ask this through your Son, our Lord Jesus Christ. Amen. Announcement. Please, the speakers, please, we'll have a short meeting before you go.
So the speakers will have a short meeting before they go. All right.